Have you ever wondered what happens to the market when a nation is in turmoil? We're not just talking about politics here. We're talking about the price of power. Today, we're diving deep into one of the president's most powerful tools, the Insurrection Act, and what it shows us about how money moves when a domestic crisis hits. That was President George H.W. Bush back in 1992, as riots were spreading across Los Angeles. It's a pretty stark reminder that deploying the military on U.S. soil isn't just some historical footnote. But what's really fascinating is how investors react to a statement like that. Do they see it as a sign that stability is on its way back, or as a signal of even deeper chaos to come? So, to really get a handle on the market's reaction, first we have to understand the legal firepower behind a promise like that. Let's dig in. What we're talking about here is the Insurrection Act of 1807. I mean, think about that, 1807. This is the ultimate tool of domestic executive authority, basically the federal government's final backstop when things completely break down. And it's been used for everything from putting down rebellions to enforcing desegregation in schools. That's exactly why even the threat of using it sends this massive signal to the market. Okay, now here's where it gets really interesting. You see, the market doesn't just have one big panic button labeled crisis. It's way more nuanced than that. It actually analyzes the type of crisis. Let's break down how investors see two very, very different kinds of trouble. Markets draw a really sharp line between two scenarios. First, you have a restoration of order crisis. Think of localized riots where federal troops, maybe even sent in under the Insurrection Act, are seen as a way to put a cap on the chaos. But then you have an institutional strain crisis. This is where the turmoil threatens the very pillars of the financial system itself, like, say, the independence of the Federal Reserve. One is seen as a problem to be solved. The other is a threat to the entire system. Let's look at the 1992 LA riots as a perfect example. After the initial shock, the market actually processed President Bush invoking the Insurrection Act as a stabilizing event. Investors basically saw it as a localized problem, not some long-term threat to the whole U.S. economy. And look at the result. Despite all the chaos on the news, the S&P 500 finished that year with a positive return of over 4%. And we saw a pretty similar dynamic play out in the summer of 2020. There were widespread protests, lots of talk about invoking the Insurrection Act again, but the markets, they didn't really panic. Why? Well, because they were focused on something else entirely: cold, hard economic data. A report that showed the manufacturing sector wasn't shrinking as fast anymore was a way more powerful signal to investors than the social unrest dominating the headlines. But now, contrast all of that with the 2026 crisis. When the Department of Justice served subpoenas to the Federal Reserve, this wasn't about restoring order on the streets. No, this was a direct challenge to a core economic institution. And the market's reaction was instant. The dollar fell, bond yields surged because investors suddenly demanded a new political risk premium, and gold took off as a hedge against what they saw as institutional decay. So, if different crises get priced so differently, what does that actually mean for specific investments? Well, there's a playbook for this. And honestly, some of the moves are pretty counterintuitive. Okay, get this. During the 2020 protests, the slogan "defund the police" was everywhere. So logically, you would expect that firms that sell equipment to police departments would take a massive hit. But what actually happened was the exact opposite. In the weeks right after the killing of George Floyd, firms with strong ties to policing saw their stock prices jump by an excess of 16.5 percentage points compared to their peers. And believe me, this was not just a short-term blip. From 2012 all the way to 2020, a portfolio of these policing-related firms would have returned 76 percentage points more than a comparable portfolio of other firms. Incredible. The market's logic here was cold and crystal clear. Investors were betting that in the face of widespread unrest, the very kind that leads to presidents talking about the Insurrection Act, governments would ultimately spend more on security, not less. They predicted that all the calls to defund would fizzle out, and instead money would pour into things like surveillance tech, body cameras, and other crime control products. And you know what? They were right. However, that whole playbook gets tossed right out the window during an institutional crisis. When the threat isn't on the streets, but inside the halls of power, the investment strategy totally shifts, from betting on a security response to just seeking shelter. And that shelter has a name: gold. During that 2026 crisis over the Fed's independence, gold hit a record high of nearly $4,618 an ounce. You see, investors weren't betting on a government response. They were hedging against the government itself. Okay, so another classic instability trade is defense stocks. But even this straightforward play has, it's gotten a lot more complicated recently. Traditionally, the logic has always been simple. Geopolitical conflict means predictable government spending, and that reduces uncertainty for defense contractors. You can see it here. Historically, during times of international conflict, these stocks have tended to really outperform the broader market. But in 2026, a new executive order came along and threw a giant wrench in the works. It fundamentally changed the risk calculation for anyone invested in the defense sector by directly tying a company's financial moves to its actual performance. This order, called Prioritizing the Warfighter, is actually pretty straightforward. First, the government identifies contractors that it says are underperforming. Then, it prohibits those companies from returning cash to their shareholders through buybacks or dividends. And finally, it forces them to tie executive pay to actual production metrics. All of a sudden, just getting a big budget isn't enough. You actually have to deliver. So after looking at all these different scenarios, what's the big takeaway here? What is the one thing that truly spooks investors? Well, it seems pretty clear that markets are sophisticated. They can absolutely tell the difference between a riot that will eventually be contained and a crisis that corrodes trust in the whole system. Civil unrest can, paradoxically, be a bullish signal for security stocks. But a threat to an institution like the Fed, that creates a political risk premium and triggers a genuine panic that punishes the US dollar. And as we've seen, even reliable old trades like defense stocks are now complicated by new regulatory risks. It all leads to one final, kind of provocative question. We've seen that investors often bet that the response to domestic unrest will be more spending on control and security. So if the market's default position is to profit from the expansion of the security state, what does that tell us about what investors believe is the true foundation of economic stability?